Are you ready to build, grow, and protect your investments? Welcome to the Index Investing Show, where we give you the tips, tools, and philosophy for reaching your financial goals. And now, your host, inventor of the Portfolio Report Card and author, Ron DeLegge.
Coming up on today's program, sectors as substitutes for individual stocks. We're going to share with you some strategies on how to use ETFs that follow industry sectors to your advantage. Also coming up, we're going to get into some of your emails and calls. If you'd like to join us to talk about a particular stock, mutual fund, ETF, or investment strategy, we can do that. 844-305-7800 is the number. Do give us your first name along with your city. You can also tweet the program at Index Show is where you find me on Twitter. We'll also get you caught up what's going on the Twitter feed a little bit later. So let's discuss what's going on with global financial markets. Here we are already in March, and thus far a pretty good year for most of the asset classes, major asset classes throughout the globe. When we look at stocks, bonds, commodities, real estate, everything up in positive territory. My goodness, what a difference a few months make. It was just in November, December, wasn't it, when markets were crashing, and now we've seen a sharp rebound. And it's the opposite extreme, as I've told you many, many times before. This is a market of extremes, and right now we're seeing extreme, I don't know if you want to call it greed, but an extreme rebound. If we take a look at the CNN Fear and Greed Index, which we've referred to many times before in the past, right now we're in greedy territory, according to the Fear and Greed Index. Remember, 0 is extreme fear, 100 is extreme greed, and right now the Fear and Greed Index is at 72. Lest I remind you, just a few months ago we were close to 0 in terms of extreme fear. 1 month ago we were at 58. 1 year ago we were at 8. So here we are at 72. So financial markets, if you believe the Fear and Greed Index and its current reading, we are in greedy territory. Now, if we take a look just at the broad market indexes and the ETFs following them, total U.S. stock market up by over 13% since the start of the year. VTI. BND is the total U.S. bond market up 0.75%. REET follows global real estate up a nudge over 11%. USCI follows commodities as a group, and they are performing quite well, up almost 4% since the start of the year. And then international and emerging market stocks up between 9 to almost 11%. VWO and VEA follow those areas. So U.S. markets on a global basis outperforming their international peers. I think the one exception would be Latin American stocks, which continue to be hot and on fire, especially Brazil. And we'll get caught up a little bit later on what some of the industry sectors within the market are doing and which ones are really driving a performance. 844-305-7800 is the number. We're here if you'd like to join us. You want to talk about anything on your mind, any particular stocks, mutual funds, ETFs, we can do that. By way of reminder, if you ever miss our regular radio broadcast, you can pick up our show via archive. We podcast every single broadcast. You can listen a couple of different ways. You can go to indexshow.com, listen there in your browser. You can also go to Spotify, iTunes, and listen there. Also Google Play, and listen there in your app. Or you can listen on YouTube. Just search under the Index Investing Show. Now, I want to give you some update. There was a couple of interesting studies on exchange-traded funds, actually a pair of studies, talking about the role of ETFs on the allocation decisions being made by today's investors. Now, that includes individuals. It includes institutions. It also includes financial advisors who manage money for individual investors. So the ETF study, Historical Perspective, it was conducted by Charles Schwab, and it looked at the trends in ETF investing going all the way back to 2011, and it found that more than half of financial advisors surveyed currently use exchange-traded funds as their primary portfolio management vehicles. Pretty interesting. More than half. Not using closed-end funds, not using mutual funds. They're using exchange-traded funds. And what was particularly interesting is going forward, this same group of advisors surveyed by Charles Schwab expect that number to grow. So right now it's over half of the surveyed group of advisors already using exchange-traded funds as the primary portfolio management vehicles, but now they expect that to grow. 64% of that group surveyed expect that number to go even higher in the terms of the usage and making ETFs even more of a bigger player in terms of their role inside portfolios that they're managing. There was a parallel study by Brown Brothers Harriman, which examined some of the same metrics, except it did kind of a different audience. It wasn't so much focused on advisors, but it also examined them along with institutional investors. We're talking about that could be insurance companies, pension funds. It could be large hedge funds, also fund managers from around the globe, and they found some very similar striking results. And in the U.S., 66% of the advisors and institutions surveyed hold almost 50% of their client assets in ETFs. Well, somewhere between 30 to 50% of their client assets in ETFs. And among the global respondents, they too expect an increase in their level of ETF holdings over the next 12 months. So from an individual investor's perspective, what is this really telling us? What does this mean? Well, first of all, it means that exchange-traded funds are no longer secondary or third-class or evolving products. They're mainstream all the way. And they've established themselves as portfolio building tools. And so we see, for that reason, financial professionals, including individual advisors as well as institutions, using exchange-traded funds as their primary portfolio building tools, their go-to vehicle for constructing and building asset allocation models. So for the individual investor, that's a natural message of what you should be doing yourself, because of the fact that exchange-traded funds make that job of asset allocation so easy. And we've talked about this so many times on the program. The framework for constructing an investment portfolio that I teach on this program and also in my online classes is exactly that. The core of the investment portfolio should be broad, it should be diversified, it should be low cost, it should be reaching the 5 major asset classes: stocks, bonds, commodities, real estate, and cash. That's your core. And you can achieve your exposure. You want to choose ETFs that are good proxies for those asset classes. In other words, they follow those groups very, very closely and do it in a way that's cost effective and efficient. So anyway, these are some things that we're sharing with you that I thought I would alert you about. Now, coming up a little bit later, we're going to talk about sectors as substitutes for individual stocks. If you own any individual stocks inside your investment portfolio, you're going to enjoy today's program. So stay tuned for that. 844-305-7800 is the number. I'm Ron DeLegge. This is the Index Investing Show. We're here if you'd like to join us. Give us your first name along with your city. More when we return. Be here or be nowhere.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
Okay, some of the things on our Twitter feed. By the way, at Index Show is where you find us on Twitter. Baby boomers' parting gift to the workforce. One last mess. I mean, what mess haven't baby boomers created by sheer force of their large numbers? So that's an article from the Washington Post that I thought you would enjoy. Another thing on our Twitter feed is this thing about a introduction of a tax on trades, stocks and bonds. Every time you buy and sell one, there was a proposal made by Senator Brian Schatz, who said, "Hey, let's tax every single trade that investors are making. We need to generate some revenue." Here's my thought on that. I think if you're trying to discourage people from investing in stocks and bonds and whatever other securities that are out there, if you want to discourage people from doing that, then I think having a tax on stocks and bonds is a great idea. No better way to discourage investing than to start taxing transactions every time you buy and sell. Here's another retweet. This is from Ryan Detrick. He is at LPL. He's a senior market strategist. He linked over a interesting chart. He looks at a lot of historical data on equity performance, and this is what he had to say. Looking like the S&P 500 will be higher in January and February, and since 1950, that's happened 27 times, and the final 10 months of the year that has occurred, the final 10 months were higher 25 times out of 27 times. So pretty stunning performance, historically speaking, if you have a strong January and a strong February, as we have had in stocks. In other words, go back all the way to 1950, when you've had stocks perform the same way they have, as they have here in 2019 in January and February, very strong, very, very bullish. That has resulted in higher markets 25 out of 27 times the final 10 months. Now, beware of historical data. It could be very, very tricky because, as we all know, it's fun to look at. We definitely don't want to count our chickens before they hatch, but it's a reference point. I always hold the same line of the future, but it, as Mark Twain said, it sometimes it rhymes. That's what we find. And so we'll just have to just wait and see. Right now, the trend, though, is sharply up. I mean, market technicians like Ryan Detrick, and he is a market technician, he'll tell you that. I mean, the markets are clearly, and they've changed on the dime. That's what's so intriguing about this particular rally. It began out of nowhere. It began in the middle of a mini crash. And so that's where we're at right now. Will we get a correction? When will it be? Well, we take a look at indicators like the VIX, which have been beaten down. There's not much fear. There's a lot of complacency right now if you just take a look at indicators like that. And so we'll have to see if we get a pullback. If we do, it'll be a good opportunity maybe to add to some of those bullish positions. But in the meantime, it is what it is, whether you agree with it or not. The beautiful part about investing is there's always opportunities somewhere. There's always opportunities lurking. And this is why we tell you that one of the key components of a well-built portfolio is cash. Now, there are certain people and certain individuals out there that teach that you should always be fully invested. And I couldn't disagree with that more. In fact, if you look at the world's greatest investors of all time, one of the attributes that is striking and that is similar is that they are never fully invested. In fact, if they were fully invested at all times, they would never be able to take advantages of dislocations in the market when they happen, because they'd be fully invested like everyone else. And the only way that they could take advantage of declining markets or whatever else would be to sell when prices are falling and raise cash and then buy whatever they're looking at. But that's not the way they invest. That's not the way the world's greatest investors approach their art. And so I suggest the same thing for our listeners. Now, the exact amount of cash in a portfolio will be highly dependent on you. You know, of course, cash is also a form of safety. We talk often about margin of safety, having a cushion. So it's relative. Your cash position may not be as large as another person's, even though you may have the same age, you may have the same target retirement date, but those numbers are variable and highly personal. And those are things that you have to determine for yourself. And if you're unable to do that, then you should be seeking financial advice and get that help from a financial professional. I want to get into some of your emails. Dear Ron, I want to invest in biotechnology, but I'm not sure which stocks or ETFs are best. My preference is towards smaller companies. Signed, Terry. And I'm not sure where Terry is writing from, but thank you for that email, Terry. We appreciate that. And biotechnology is a very, very growth-oriented sector. Biotechnology includes companies that are looking for the next big drug. They're looking for solutions to big league problems like heart disease and cancer and things that afflict mankind. We're looking for solutions. And so one of the ETFs that comes to mind is the iShares NASDAQ Biotech ETF, ticker symbol IBB. This is what we might call the granddaddy of all biotech ETFs. It's got just over $8 billion in assets. It's got very active trading volume on a daily basis. And you take a look at some of the top holdings in IBB, and it's really the who's who of the biotech sector. You've got companies like Celgene and Biogen and Amgen and Gilead Sciences. I mean, this is the who's who of the biotech sector. But it doesn't exactly fit Terry's profile, because Terry mentioned that she's looking for smaller company biotechs that are smaller cap. And if you take a look at the average size of the stock in IBB, it's a $37 billion market cap, which leans towards large. So ticker symbol SBIO is one ETF, Terry, that you should definitely put on your radar. And it's called the Alps Medical Breakthroughs ETF. And that's ticker symbol SBIO. And just so you know that the average market size of stocks that SBIO holds is just over $2.7 billion, which is right up your alley. You're looking for companies that are small cap, maybe even on the edge of being mid cap, but $2.7 billion. I like biotechs in that range because it gives them a lot of opportunity to grow. You may have companies in that size range that are actually able to triple or even become 5 or 10 baggers. It's difficult to extract and pre-identify them before they do that. And so a fund like SBIO would be, I think, a good one to look at. And so put that one on your radar screen. So that's the biotech sector. If you'd like to join us to talk about a particular stock, mutual fund, ETF, coming up a little bit later, we're going to talk about sectors as substitutes for individual stocks, how to do that. I'll be right back after this short break. Go nowhere.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
First, the basic idea. Working people defer the money they earn. Next, that money can be used in the future to pay for basic living expenses, so long as it's wisely invested. To acquire these skills, tune in to the Index Investing Show with Ron DeLegge, a carefully designed program for working people who save and invest money. The Index Investing Show is now available at iTunes, Spotify, YouTube, and other world-class platforms.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
All right, some standout performers in terms of industry sectors. So we can take a look at the financial markets a couple different ways, and I try to always give you different perspectives and different angles. We look at this, of course, on a broad basis in terms of global performance, and we can also look at it in terms of industry sector performance. In other words, what are the specific groups of stocks, which industries are driving financial markets higher? And if we just take a look at leading sectors within the S&P 500, I mean, you've got all industry sectors in positive territory in 2019. So what does that tell you in terms of market breadth and participation in this rally? But beyond that, we've got certain sectors really delivering strong double-digit returns. A couple of ETFs that I want to alert you about. Ticker symbol XLI, which tracks industrial stocks, has been a top performer. It's ahead by almost 19% since the start of the year. Pretty amazing performance from industrial stocks. Now, this includes companies like Boeing and GE and 3M and Honeywell, among the largest stocks within XLI. And there are 70 companies in this particular industry group, and that is, again, a top performer. Along with energy. Energy is another one, XLE, ahead by almost 16%. And as we told you earlier, the total U.S. stock market's ahead by around 13%. So these are sectors that are outperforming the broader market. Energy includes 29 stocks, and we've got some familiar names like ExxonMobil, Chevron, Schlumberger, ConocoPhillips, all inside ticker symbol XLE. And then one last leading sector that we need to tell you about is the technology sector, ticker symbol XLK, which represents about just over 20% of the S&P 500's overall weighting. So that's a pretty big influence in terms of performance on the S&P 500. In fact, it is the biggest industry sector within the S&P 500. It's got 68 stocks, and XLK holds companies that you know, that you've heard of, companies that are changing the way that we deal with technology. They're improving it. They're dealing with companies that are doing software, and also include some chip makers, companies like Oracle, Adobe, IBM, Salesforce, and Broadcom, just a couple of the companies within XLK. So that's what's going on in terms of industry sector performance and the ETFs tracking those top industries within the S&P 500. 844-305-7800 is the number. You're listening again to the Index Investing Show. My name is Ron DeLegge. We're here every week at this same hour teaching you the birds and the bees of successful investing. What good is knowledge if you don't put it to use, right? You can take in all the knowledge in the world. You cannot continue to absorb information. And invariably what I see are different types of folks. There's some that continue to absorb information and they do absolutely nothing with it, which is a darn shame. They continue to learn, and never apply what they learn. What good is that knowledge in all the world if you never apply it or plan on using it? It's useless. Why are you wasting your time? So on this program, we want you to absorb the information, but we want you to apply it. We want you to use it and take action to make better investment decisions. The other thing I see is analysis paralysis, where those certain demographic of individuals are constantly having to reanalyze and analyze the data and take a deeper dig into it and look at it a little bit more closely. This tends to be the more analytical minds, perhaps the engineers, because I guess that's the engineering mind. There's nothing wrong with being analytical. There is something wrong with being overly analytical or hyper analytical when it comes to your investing. What it does is it stunts your ability to take decisions and make decisions. And so this is definitely a flaw, a glitch that you want to avoid, is having analysis paralysis, where you're constantly, every way you turn, you're constantly stopped in your tracks, but from making a decision, because you have to analyze data. And so what you need to understand is there's really not much here to analyze in terms of making investment decisions. We try to make it as simple as possible. The one thing that you do need to analyze and understand is that indexing wins over the long run. Indexing, from an analytical perspective, is one of the brightest and smartest investment decisions a person can make, because you immediately turn the odds of success in your favor, statistically speaking. Now, from year to year, you may have certain years where certain fund managers outperform, but you'll see over the long run that they're unable to sustain that performance as a group, and so that's why indexing wins. Now, in terms of picking individual stocks, here too, indexing excels, and it does so not just at a broad-based level or broadly diversified level, but even in a sector basis. Now, there was some research conducted by State Street Global Advisors, and they examined how stock pickers do. And what they found is that the odds do not favor stock pickers. And this also confirms my own findings with the portfolio report cards that I've done on this program for listeners just like you. I have found that the vast majority of stock pickers do not outperform not just the broader market, but also the peer sectors of the stocks that they're selecting. And so State Street found out, and they just looked at S&P 500 stocks, they found out that just 28% of stock pickers outperformed their peer sector. So if we just reverse that and help you understand the magnitude of what we're saying, so we're saying that 72% of stock pickers were unable to outperform that peer sector of whatever stock that they picked. So what's the alternative? Because we discussed this at the top of the show, using sectors as substitutes for individual stocks. Take a look at your investments. Do you have any laggards? Do you have any dogs inside your portfolio? Stocks that are just, they make you want to puke. Puke-worthy companies that have just not lived up to their expectations. Companies that you may have held for a while that are dragging down your performance. So what do you do with those companies? Well, one idea is to take a look at the industry sector in which that company lives. So you may have bought that company believing strongly that whatever technology or whatever thing that they're developing was going to be a big, big deal in the future. And maybe that company wasn't able to execute. Maybe they had product failures. Maybe their management team did not deliver the results. But maybe that company is still in a good sector. We see this, for example, in the biotech sector, which we discussed earlier, where there's a lot of product failures. And for that reason, a lot of companies never become Amgen, they never become Biogen, they never grow up to become biotech giants. And so, for example, if you've got, let's just, since we're talking about individual companies, if you've got a dog, let's say, in the utilities sector, you can take a look at ticker symbol XLU and simply swap out that position. Swap out that position in that utility stock, swing it from an individual holding into XLU, which contains a group of utility stocks, and that would be one way to transition. You can still stay invested in that same industry group, utilities, but now you're doing it in a more diversified way. We'll continue the conversation when we come back. This is the Index Investing Show. I'm Ron DeLegge. Go nowhere.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
Okay, other news in the ETF and financial world. Vanguard just reduced expense ratios on 10 of its exchange-traded funds. There's another company called Social Finance that's planning to introduce a series of zero-fee exchange-traded funds. So there's a continuing battle that wages with mega-sized firms cutting expenses on their lineup of funds, which is to the benefit of us, the investing public. Meanwhile, there's also a battle for your business with large brokerage platforms in terms of the number of ETFs that are available for commission-free trading. Earlier this month, Fidelity expanded its menu of commission-free trading to more than 500 ETFs. That particular move matched Charles Schwab's plan to offer commission-free trades on 503 ETFs. That started on March 1st. Now, both firms have experienced a surge in assets. Fidelity now has more than $380 billion in ETF assets under administration. And then if we take a look at Schwab and its self-branded ETFs, they've got more than $115 billion invested in those funds. So this continues to be another beneficial thing for investors. Of course, you still have to exercise caution, even with these commission-free trading platforms. Obviously, not all the funds are necessarily going to be desirable choices just because they're commission-free, right? They need to fit inside your portfolio. They need to have a purpose for being and living inside your investment portfolio. And so that's obviously the first thing. There has to be compatibility. But the other thing, too, is that you have to be very cautious with yourself and being able to control yourself. Some of us are just like to have lots and lots of activity, and that's not necessarily to the benefit of your bottom line, just having trading activity. There has to be a purpose for why you're buying and selling ETFs or whatever else. You have to have a plan. You can't just be doing it based on emotion or gut feeling or whatever else, something you read in the news or heard on social media. So it's very important to exercise discipline, and I think you can still do that with commission-free trading platforms. And this, again, is another wonderful thing that continues to lower the cost for all investors. 844-305-7800 is the number. We're here. If you'd like to tweet the program or follow us, at Index Show is where you find me. You can also listen to our archived shows. We save every single program. We've been doing this actually since 2007. Can you believe that? That's when we first began podcasting. It was in 2007. So you'll find us on all the major platforms: Spotify, iTunes, YouTube, as well as Google Play. Now, we've been talking here about using industry sectors as substitutes for individual stocks. Now, why would we do that? Well, individual stocks, while there can be the potential to hit a home run, there's also the potential to strike out. And as I indicated earlier, most stock pickers strike out with pretty high regularity. 72% of stocks picked by stock pickers fail to beat their peer industry sector. So what does that tell you? It tells you that you'd be better off just investing in that sector that you believe in. So if you believe that technology is the place to be, you don't need to pick individual stocks within that sector. You can just pick the basket. Go with something like XLK, which tracks the technology sector. If you believe in the communications and social media companies and the growth of that, you can go with something like ticker symbol XLC, which tracks that area, instead of trying to pick which individual companies within that group are going to be the the big winners. Now, you also can play this leveraged ETFs. If you really are a bull or really are a bear, you can play that sector. Just taking a look at that same example, Communication Services, Direxion offers 2 ETFs that offer bullish and bearish exposure to that group. So, for example, TAWK offers triple daily exposure to that group, Communication Services stocks. If you're bearish, you can go ticker symbol MUT. So that's another way to play this. The other thing about industry sector investing is you can look at it from an economic perspective. You can tilt your portfolio thematically because remember, sectors are closely aligned to specific economic variables and business cycles. And so sector investing helps you to align your portfolio with the macro environment or to capture secular growth. So there are 4 areas or 4, what we might say, business cycles that come to mind. You have expansion, you have slowdown, you have recession, and you have recovery. So which of those cycles are we in right now? Well, it appears that we're in slowdown. That's where we're at right now. And so which industry sectors are the ones that do well in a slowdown? Well, consumer staples, ticker symbol XLP, healthcare, XLV, industrials, XLI. Those are the sectors that generally, if we look at history, have performed the best during markets that are slowing down. And then the ones that don't do so well during a slowdown are areas like materials and consumer discretionary and real estate. So that's sort of kind of a historical look at it if you want to play it from a capturing economic trend perspective. So that's what sector investing allows you to do. And again, you're not putting all your eggs or wealth or savings on one company. You're diversifying it across a group of companies, and you're playing that theme. So less exposure, less risk to individual companies, especially when companies may have product failures, fail to deliver. There's so many examples of companies over the years that have fallen into that trap. General Electric is a perfect example. A blue chip company at one time, a company that could do no wrong, had the greatest management team on the planet, and yet over the past 2 decades has considerably underperformed not just the broader market indexes, but its own peer industry sector group, industrials. And so this is a testament to some of the things that can happen, some of the things that can go wrong, and often do go wrong when we try to pick individual stocks. So these are some ideas we're sharing with you on the program. Now, I also want to share with you some other performance from around the globe. We indicated earlier that certain areas of the market have been really hot globally. Latin America, Brazil have been strong performers. Some of the bullish ETFs linked to these areas, LBJ, which tracks Latin American stocks with triple daily leverage, ahead by almost 25% since the start of the year. BRZU, which tracks the Brazilian market, ahead by almost 30%. And then in terms of industry sectors, we told you the performance of the unleveraged funds. Well, if you see strong performance in a certain area and that momentum is in whatever direction it is, if it's bullish or bearish, that is usually a good time to be using leverage, and it's paid off. DUSL, which aims for triple daily performance to industrial stocks, a star performer. And then one last one, DRN, which tracks the real estate sector, up just over 37%. Well, that does it for another episode of the Index Investing Show. On next week's program, we're going to be doing a portfolio report card for DL. And stay tuned for that. We'll talk again next week.
Thank you for listening to the Index Investing Show with Ron DeLegge. Connect with us on the web at indexshow.com. And be sure to subscribe to our podcast at iTunes, Spotify, or Google Play.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.